So this is very, very bizarre. It's very weird. Despite Trump tightening the chip war against China, despite all the noise about competition between the world's two largest economies, Trump keeps posting pictures of himself and President Xi on Truth Social, side by side, smiling, like old golf buddies. And now Trump is saying China respects the United States again. Here's the clip. Years and years they ripped us off like nobody ever got ripped off. Now it's a very profitable business that we do with China, and they respect our country again. We have the strongest military in the world by far, and they respect our country again. Now, I don't know which part of the current US-China relationship genuinely looks like mutual respect. Trade war still active, chip restrictions still in place, diplomatic tensions still simmering. But apparently that's respect now. And then it gets even stranger. Trump said in a recent interview that Xi Jinping marveled at how the US is the hottest country in the world, that Beijing looks up to America. So we've gone from respect to outright adoration in the space of a few weeks. It's just weird, and it tells you something important. Someone in this administration is not operating in the same reality as the rest of us. And that gap between the official narrative and what's actually happening in the data is exactly what we need to talk about today, because the numbers tell a very different story. Now, what Trump actually wants is not hard to figure out. He wants trade with China to resume as quickly as possible. And the reason is straightforward. The Iran war has created an inflation crisis that is actively threatening to blow up both the economy and the financial markets at the same time. That's not a small problem. That's the kind of problem that ends administrations. Let's look at the inflation numbers, because they tell the story clearly. When the war started in February, US inflation was sitting at just 2.4%. Not great, not terrible, manageable. By March, it jumped to 3.3%. By April, it hit 3.8%. And the trend line is not ambiguous. It is pointing in one direction only, and that direction is up. Now here's why that matters so much. Higher inflation means higher interest rates. Higher interest rates mean a more expensive economy for absolutely everyone. For businesses borrowing to expand, for families carrying mortgages, for the government servicing its own debt. The whole system gets more expensive simultaneously. And Trump knows that without China as a trading partner, he has lost one of his most powerful tools to manage this crisis. Cheap Chinese goods were a natural pressure valve on inflation. Without them, the pressure builds. And the data already reflects that. US exports to China have fallen by $35 billion in 2025 alone. American companies are earning significantly less from the Chinese market. But the bigger hit, and this is the one that lands directly on households, is on the import side. The US has lost access to roughly $129 billion worth of affordable Chinese goods thanks to the tariffs. Every dollar of lost cheap supply feeds directly into the inflation problem. This is not abstract economics. This is grocery bills and fuel costs and the price of everything that gets manufactured somewhere and shipped somewhere else. Now, some viewers will say, and fair enough, that the real inflation number is higher than what the government reports. You're probably right. The official figures measure a specific basket of goods in a specific way. Real-world costs for real households tend to run ahead of whatever CPI says. So if the official number is 3.8% and climbing, the felt reality is likely worse. Keep that in mind as we go through the rest of this. The oil situation makes everything even more urgent, and it's one of the most underreported dynamics in this whole story. Yes, the paper price of Brent crude is sitting below $100 a barrel on the futures market. That sounds fine, but here's the thing. The physical price of actual oil, the real barrels that actually get delivered to actual refineries, is still $10 to $20 above that paper price. The financial oil market and the real oil market are telling two completely different stories right now. And the one that matters for your fuel costs is the physical one. Trump either isn't seeing this clearly or doesn't want to admit it publicly. There are workarounds happening in the market. Some Russian supply is helping fill gaps. Saudi Arabia is rerouting oil through the Red Sea. But it still isn't enough, and the math gets alarming fast. If the Hormuz Strait stays disrupted, analysts are looking at a potential shortfall of 7 million barrels per day with no easy way to plug that gap. The Strategic Petroleum Reserve release, yes, Trump will do it, won't come close to covering a shortage of that scale. And if China comes back into the market buying aggressively again, which it will, the demand side of that equation gets dramatically worse. 7 million barrels of daily demand destruction to balance the market means, in plain English, a consumer collapse. And a consumer collapse means a potential economic crash. That's the tail risk sitting under all of this. Against that backdrop, the US needs every source of economic support it can find. and China just cut off a very significant one. Let's talk about what that actually means in practical terms, because this part of the story rarely gets the attention it deserves. China has a domestic savings pool of over $51 trillion. That is an almost incomprehensible number. And for years, a meaningful portion of that retail money was quietly flowing from mainland China through Hong Kong into international markets, including the US. It wasn't loud, it wasn't headline news, but it was real and it was substantial. Beijing just closed that loophole, and they didn't stop there. China is now moving to keep capital locked inside the country, making it significantly harder for Chinese money to flow outward toward markets that Beijing considers unfriendly. And this matters enormously, not just for the financial flows, but for what comes with the money. Because when Chinese firms invest overseas, they bring capital and genuine expertise, real operational knowledge, engineering capability, manufacturing know-how built over decades. In 2025, China invested nearly $150 billion around the world in non-financial sector investments. Real factories, real supply chains, real physical infrastructure. That capital is now being redirected away from the US and toward markets more aligned with Beijing. Under the new regulations, sensitive assets cannot be transferred overseas without explicit government approval. Even technical training to foreign parties could be restricted or banned entirely. The knowledge transfer pipeline is being closed alongside the capital flows. Both taps turned off at the same time. Here's what Trump won't acknowledge publicly, and this might be the most important point in this whole video. The US is not as self-sufficient as he keeps claiming. China has invested at least $200 billion into US technology and infrastructure projects over the years. That money is spread across roughly 2,500 projects touching almost every single US state. This isn't some niche arrangement on the margins of the economy. Chinese capital is deeply embedded in the American economic fabric, and pulling it out is not painless. GE Appliances is the perfect example of how this actually works in practice. The company was acquired by the Chinese firm Haier, and Haier chose to keep manufacturing in Kentucky, not in China, in Kentucky, because it made logistical and economic sense to produce closer to the American customer. Labor in China isn't as cheap as it used to be, and manufacturing close to your market has real advantages. If you want genuinely cheap manufacturing today, you're looking at Cambodia and Vietnam, not Shenzhen. These are exactly the kinds of pragmatic, mutually beneficial Chinese investments the US stands to lose if Beijing makes outbound investment harder. And they won't be replaced by some domestic alternative overnight. That's not how industrial capacity works. Trump doesn't fully grasp how much of America's current economic output is quietly supported by Chinese capital. The US is wealthy in part because of that relationship. Cutting it doesn't make America stronger, it makes America poorer. And the substitute being offered, doubling down on AI as the single engine of future growth, is an extremely concentrated bet for the world's largest economy. If that one engine sputters, there's no backup. Meanwhile, China's own position keeps strengthening. Their export machine is only getting more powerful. Yes, their imports aren't growing much. China is largely self-sufficient and getting more so. But their exports have surged dramatically since 2020. The world needs affordable goods, and China is the most efficient producer of them at scale. When you measure Chinese investment by actual physical output, factories built, infrastructure completed, supply chains established, the scale is more than 3 times the US equivalent. The impact on engineering, manufacturing, and physical infrastructure is simply not comparable. And that advantage is compounding. Here's why. The Chinese yuan is strengthening. The renminbi has gained more value against its major trading partners since 2022 than at any point in recent history. Investors are finally pricing in China's structural position properly. Their economy has limited exposure to the Middle East energy crisis. Their energy supply is diversified: domestic solar, hydroelectric, and Russian pipeline supply. Their trade surplus keeps growing. Their currency reflects all of that underlying strength. And a stronger yuan creates a compounding problem for US debt. As the yuan appreciates, Chinese bonds become more attractive to global investors in real return terms. Capital that would previously have flowed into US treasuries starts flowing into Chinese bonds instead. The US debt market loses another buyer base. And the US debt situation is already at a genuinely dangerous level. Total national debt, $39 trillion. Annual deficit running above $1.7 trillion. Annual interest payments alone have hit nearly $1.2 trillion. Interest payments, every year, just to stand still. Rates simply cannot keep rising without directly threatening the government's own solvency. That's not hyperbole, that's arithmetic. The data center situation adds another layer of fragility on top of all of this, and it's one that doesn't get enough attention. Construction spending on data centers has now overtaken transportation infrastructure spending in the United States. It's hit $50.7 billion on an annualized basis. Since 2022, data center spending has surged by over 350%. All of that capital deployment, all of that optimism, depends entirely on bond yields not exploding higher. If the Iran war drags on, if Chinese investment money keeps draining away, if inflation keeps pushing rates up, the data center bubble gets closer and closer to a painful correction. And when that correction comes, it takes a meaningful portion of the stock market's recent gains with it. That's the sequence worth watching. Now, while all of this is playing out, the Trump administration is trying to revive the tariff war through the back door. And the justification they landed on is forced labor. This is wild. The Supreme Court struck down the previous legal basis for the trade war. Trump stands to lose significant tariff revenue as a result. So the administration needed a new justification, and U.S. Trade Representative Greer stepped up with 34 categories of goods from various countries allegedly containing inputs made with forced labor. The list covers everything from cotton used in garments to critical metals for solar panels to palm fruit for palm oil production. Now, the irony here, and the comment section has already noticed this, is that the United States runs the world's largest prison labor system. Over 2 million incarcerated people, many working for pennies. The forced labor accusation directed at China and 59 other countries, coming from Washington, has a certain quality to it that audiences around the world are not missing. But let's set the irony aside and look at the economics. Because even on its own terms, this strategy doesn't work. At its absolute peak, tariff collection was bringing in around $30 billion per month. The annual deficit is running above $1.7 trillion. Even maximum tariff collection every single month barely makes a dent in that gap. Meanwhile, tariffs raise costs for every U.S. industry that depends on imported inputs, which is most of them. During Trump's first term, manufacturing jobs actually collapsed by over 100,000, despite all the rhetoric about bringing production home. The jobs didn't come back. The factories didn't materialize. The same dynamic is setting up to repeat itself. Tariffs raise costs for U.S. producers and consumers. They trigger retaliation from trading partners. They reduce the flow of affordable goods that were helping keep inflation manageable. And they push countries like Canada, Mexico, and Europe to deepen their trade relationships with China instead. Canada and China were the only two countries that retaliated against the U.S. directly, and the Canadian response, in particular, is worth understanding. When you threaten to annex someone's country and slap tariffs on their exports, they don't just nod politely. They find other trading partners. And those partnerships tend to outlast whoever is in the White House. So let's step back and look at the full picture clearly. The Iran war is driving inflation higher every month. China is cutting off capital flows and closing investment channels into the U.S. The yuan is strengthening while the dollar weakens. The national debt has crossed $39 trillion with no credible plan to reduce it. Data center spending is running at bubble-level valuations, entirely dependent on stable rates. And the response to all of this is a tariff war justified by forced labor accusations. It's a lot. Now, what do you think? Will China continue pulling back their investments from the U.S. economy? Can the tariff approach ever genuinely revive American manufacturing, or is it just economic theater? And the bigger question underneath all of this, if AI stumbles as a growth engine, and Chinese capital keeps leaving, and rates keep rising, what exactly is the American economic story built on? Let me know in the comments below. Drop where you're watching from. Always good to see how global this conversation is. Stay safe, smash the like button, and subscribe, because this story is not slowing down, and neither are we.